Even at the April lows, just to be clear, our S&P year-end target was 6,600. So we were still expecting explosive recovery in markets. But we are above that level. And, we're 10 weeks before the end of the year and the S&P is at 6,800. I think it's still a base case then for people to say that in just a typical year, the S&P should gain another 4%. That would put us over 7,000 into the end of the year. And I think that that's sort of the minimum. But because we've got the Fed cutting, and they started in September, they've been on pause all year. That only happened twice in the last 50 years, which is 1998 and 2024. I actually think the S&P, given the skepticism that's been plaguing this market all year, we could do far better than 4%, maybe even 10% into year end.
The market is clouded by fear, inflation chatter, interest rate speculation, and endless headlines claiming the consumer is weakening. But history has always favored the investors who look beyond the noise and position themselves before the tide turns. Because beneath this uncertainty, a powerful shift is unfolding in retail, a shift that only becomes obvious once the rally is already in motion. Consumer behavior is changing, e-commerce demand is accelerating again, and retail giants are adapting at a speed no one expected. November is the month that sets the stage for the retail sector, and those who position early often capture the biggest upside before Wall Street upgrades begin, before holiday earnings surprise the market, and before the next leg of this retail rebound takes off. Today, we're diving into 3 retail stocks that stand at the heart of this transformation. One that offers unstoppable strength and resilience, one that represents global digital growth and innovation, and one that is a beaten-down turnaround story with high-reward potential. 3 different paths to profit, 3 different ways to win as we move into November. Let's begin. Walmart WMT, the retail fortress evolving into a digital growth engine. Walmart is no longer just the reliable defensive name investors run to during uncertain times. Today, it has become one of the most impressive and underestimated growth transformations in the market. In its most recent quarter, Walmart reported $169.3 billion in revenue, up 4.8% year over year, proving that strength is coming from every part of its business. What truly stands out is how fast Walmart is evolving into a digital-first retail ecosystem. E-commerce sales surged 21%, with store-fulfilled delivery growing nearly 50%, showing how efficiently Walmart has fused physical stores with digital convenience, logistics, and fast delivery. The omni-channel model that Walmart has built, where stores act as fulfillment hubs, has become a competitive weapon that even Amazon cannot fully replicate at this scale. Walmart also raised its full-year outlook, now projecting net sales growth between 3.75% and 4.75% and operating income growth between 7% and 8%. But the hidden engine that could transform Walmart's earnings in the years ahead is its advertising division, Walmart Connect, a high-margin business similar to what turned Amazon into a profit powerhouse. As more brands fight for exposure across Walmart's physical and digital shelves, advertising revenue could meaningfully lift margins without requiring large revenue increases. This is a dominant retailer, a digital innovator, and a profit-expanding advertising platform all in one. As we step into November, the strongest seasonal period for consumer spending, Walmart isn't just a safe pick. It's a growth, defense, and digital leadership story at the same time. Shopify, Shop, the e-commerce growth catalyst entering its next supercycle. If Walmart represents retail domination, Shopify represents entrepreneurial acceleration. Shopify has become the backbone of global e-commerce, empowering millions of brands, creators, and businesses to build and scale online. And the momentum heading into 2025 looks stronger than it has in years. Shopify posted a powerful Q2, generating $2.68 billion in revenue, up 31% year over year, while gross merchandise volume soared to $87.8 billion, also up 31% from last year. Profitability is no longer a question for Shopify. Its free cash flow margin hit 16%, proving it has transitioned from a growth-at-all-costs tech company into a financially disciplined, profitable growth machine. What makes this growth even more compelling is that international markets are now expanding even faster than North America, signaling Shopify's evolution into a global commerce platform, not just a US-centric solution. Shopify's next stage of growth will be fueled by AI-powered merchant tools, global payments expansion, logistics and fulfillment innovation, and the explosive rise of social commerce driven by creators and content-led shopping. With interest rates expected to ease in 2025, entrepreneurship and online business formation could accelerate dramatically, and Shopify will be at the center of that wave. November is the early accumulation window, right before Shopify enters its strongest seasonal stretch and retail spending surges online. This is a stock that has the potential not only to outperform during the holiday period, but to lead the next multi-year e-commerce growth cycle. Target TGT, the high upside turnaround story hiding in plain sight. Target is the most intriguing opportunity on this list because, unlike Walmart and Shopify, its stock is not priced for success. It is priced for doubt, and that is where smart investors find asymmetrical upside. Target's latest quarter showed a business still working through a transition, with net sales of $25.2 billion, down 0.9% year-over-year, and comparable sales falling 1.9%. Operating income declined to $1.3 billion, a 19% drop, driven by tighter margins and a more value-focused consumer. On the surface, the numbers appear weak, but beneath them lies the early blueprint of a comeback. Target's digital sales returned to growth at roughly 4.3%, showing that customers are re-engaging online. Management has been aggressively cleaning up inventory, improving product assortment, and shifting more attention to essentials, value, beauty, and categories where spending remains resilient. And despite the challenges, Target paid $509 million in dividends and still has $8.4 billion authorized for share buybacks, proof that leadership has confidence in the company's long-term trajectory. With expectations at rock-bottom levels, the path forward no longer requires perfection. It only requires improvement. If holiday results outperform, if margins recover even modestly, and if sentiment begins to shift, Target could flip from a laggard into one of the strongest rebound stories of 2025. The upside is magnified because skepticism is high and valuation is compressed, conditions that historically set the stage for powerful reversals. As we step into November, the retail sector is entering the most pivotal part of the year. Walmart offers strength, stability, and accelerating digital growth. Shopify gives investors exposure to the next global e-commerce expansion wave. Target provides the high-reward turnaround potential that can generate outsized gains when sentiment shifts. 3 different strategies, one common theme: positioning early before the data, the headlines, and Wall Street finally acknowledge what's already beginning.